So you can see we're a very, very strong dealer position there, very, very heavy strong. We're talking about 500 contracts. It's not a small position, guys. It's about a net position of about 500 short. So on the basis that there's a net position of about 500 short contracts going in there, is that good enough to sell against? Kind of. So I did, as I said, take a sell against that trade just before the cash open. It dropped down, it spiked, I took some profits, it came back up and it scratched me out for a profit of a small profit. And then I resold back against the Voltics and the traps here. Resold against that there, and we've now seen this trade making now $2,700. Dealer positionings, pretty good, right? Anybody? Dealer positionings, pretty good. Do you agree with that, guys? Damn right I agree with that. Sure is, Ray. Cheers, bud. Well, I got some short NASDAQ on the pullback there. We did get a max signal, but unfortunately it was at the same time as the oil was coming out, so I wasn't able to give much of a shout out about it, guys. Sorry, guys, I'm stretching that chart. What the hell am I doing? So here's the NASDAQ sell that I've got on the books. And you might be saying, why did you get a NASDAQ sell? Because the max sold it, and that's why. So we can see that there was a max signal just on that pullback there. That pullback is this pullback here. So you can see that the max signal came in just here for a short NASDAQ trade. That was that sell trade that we've taken there. And you can see we've been able to get a very, very easy ride off that. Now Max has actually flipped that trade over. Unfortunately, it was too slow because I've been taking screenshots to show you what Max was doing. So Max bought it back at the lows here, and I'll show you that in a second here. So there's the Max trade as it's happened there. So that sell was able to make some profit, scratched out. This Max sell made some nice profits, very, very nice profits here. That's the sell that I'm showing you. But as I've been talking, of course, Max decided to close off that trade with a quick reversal buy trade off of 54s up to 60s, and was able to make a quick profit on that reversal trade just there. And you can see obviously that the buy trade's done okay. It's managed to make some money, not a lot. So still 100% winners for the bold Max at the moment, guys. 100% winners, but a couple of scratches in amongst those, which is okay. That's expected. It's expected. It's expected. It's expected. So how did the dealers do on that S&P eventually? Have we came up with a conclusion about how the dealers are doing at those higher prices? Well, they did it again, didn't they? They've taken that trade short again at the higher price. So they sold that, somebody bought into this breakout trade here, and the dealers seem to be taking that sell trade on their books again at those higher prints, yeah? Do you agree with that? So they've taken that trade again into those higher prints, and we've had a reasonable sell away from those higher prints. So you can see that the dealers still incredibly short equities, guys. Now, obviously, that's worrying going into a FOMC, isn't it? When you think about it, why would the dealers be getting heavy short equities going into the FOMC? Well, we can obviously try and answer that by looking at the dollar index. Now, we obviously talked about them getting very heavy long dollars. We talked about them getting very heavy long dollars off of an earlier price from yesterday, in fact, about 93.96. And they seem to be getting very heavy long dollars all the way through the morning session as well. And they've taken the dollar higher. They have managed to take the dollar higher. The only reason why we're a little bit relieved is that they have rotated out of those long dollar positions up to 94.18s, 94.20s. So they've obviously taken a lot of their profits on that dollar long position over the course of the whole overnight session. And they have managed to rotate out of an awful lot of that inventory at 94.18s. And that's where we've seen them jamming the top edge up here. You can see the dealers were very, very long into these bottom edges, very long into the bottom edges here. You can see if we look in the background a little bit further, the dealers got very long when they took the price higher. So we can see from the dealers' long positions, we can see why they were long, because they took the price up. So obviously, if you're very heavy long dollars and you're very, very heavy short S&P, that would be a really worrying sign for this outcome from the Fed. They're talking about a taper here, aren't they? That's what the dealer positioning was for the taper. Now, as I said, the only release is the fact that they've actually unwound a lot of their tapering positions here based on that uptick that we've seen there. They've pulled away and let the price go through, and they've been able to clear their long dollars at higher prices. Long dollars at higher prices, and that's why we can see that little top edge up here. And that's what we can see what's happening. That's when we can start to recognize what's going on. Is that a question or is it a point, Mike? Because obviously that durational short fits in with that narrative, doesn't it? If you're short duration, you're higher interest rates. Yeah. So Mike's point about the duration is obviously when you're talking about NASDAQ against the S&P, we're looking at equity duration. Why is equity duration getting crushed? Equity duration is getting crushed because obviously if you're dropping duration, what's happening? How do you drop duration? You raise rates. Yes? Everybody understands that, yes? Everybody gets that. So when you drop duration like equities have done so far today since the cash open, when you've dropped duration that much, you're raising rates. That's how you shorten duration, as you buy the back end. You buy the back end and you start recognizing the yield shifting. So when we understand that, we can understand if you buy duration, it's because there's lower rates coming. And that's why you buy duration. If higher rates are coming, you sell duration. You sell duration. And that results in higher rates. That's why you would expect higher rates to start coming in. Well, that higher rate story seems to fit in with the dealer selling on equities. So that dealer selling on the S&P, whether we like it or whether we don't like it, that seems to be what they're still doing. They might be wrong. They might be right. Our job isn't to decide whether they're right or wrong. Our job is to trade it, right? Our job is to trade what we see. And that's what we've always got to remember when we're trading these things. You might look at it and say, the value's bullish and they're bearish, or the value's bearish and they're bullish. Okay, so what are you going to do about it? You either have to just say, okay, I'm not doing anything, or you have to side with one of those two positions. I'd rather side with the guys that are putting money at risk, because these guys are active. These guys are actually active trading. So we've got to remember that.